Okay, I'm doing my presentation on Sanderson Farms, Head and Inquest Equipment Services, and Caterpillar. There are three questions. Which of the three companies would you choose to make a short-term loan to? Which of the three companies would you choose to make a long-term loan to? And which of the three companies would you choose to invest in? For a short-term loan, I looked at current ratio, quick ratio, and cash ratio. These ratios are good for showing how liquid a company is, which means how is their money tied up as far as cash. Do they have a lot of cash on hand, or do they have their money tied up in a lot of debt, a lot of assets. Right here, these three charts show the three different ratios. Sanderson Farms, by looking at this, Sanderson Farms looks the best. I would definitely be willing to give them a short-term loan. They have less money, as you can see it compared to Head and Inquest and Caterpillar. They have a lot less money tied up in assets, a lot more liquid money, a lot more cash on hand. For a long-term loan, I looked at financial leverage. Financial leverage is calculated by dividing its total liabilities by stockholders' equity. It indicates what portion of equity and debt the company is using to finance its assets. A high debt-equity ratio generally means that a company has been aggressive in financing its growth. Caterpillar shows their ability to manage debt over a long period of time. It's a big company, they can handle it. Sanderson Farms looks pretty good, I guess. I mean, it looks steady, but they're not borrowing a lot of money, so you can't see if they're as good at handling, paying it back. Head and Inquest to me looks the best. You can see right here where they've experienced some growth. They borrowed a lot of money, I guess invested in some more equipment, built some more dealerships and such, and they've expanded, and it's paying off. You can see there where they borrowed money, they showed that they can repay it, and they look good. I would definitely give Head and Inquest a long-term loan. As far as investing in one of the companies, I looked at return on equity, ROE, and return on assets, ROA. Return on equity measures a corporation's profitability by revealing how much profit a company generates with money shareholders have invested. So how much money can you make with the money that your investors have given you? And the higher the ratio percentage, the more efficient management is at utilizing its equity base and better return it to its investors. Here you can see Sanderson Farms is up and down. Caterpillar's not as bad, but once again, I still like Head and Inquest. You can see where they're good at managing their money. They borrow it, they expand, they pay it back. Return on assets, the ROA figure gives investors an idea of how effectively the company is converting the money it has to invest in the net income. The higher the ROA number, the better, because the company is earning more money on less investment. Now, based on ROE and ROA, I would invest in Head and Inquest equipment. Sanderson Farms looks pretty good, I guess. I mean, they bounce up and down. They got some highs, but they got some lows. But they're not borrowing as much money. They don't have as much money invested in assets. Whereas these two equipment dealerships, they got a lot of money in equipment and warehouses and dealerships and such. But Head and Inquest is who I would go with. They show that they can repay money when they borrow it. They know how to handle their money, their assets. I would definitely invest in them. So in conclusion, Sanderson Farms gets the short-term loan, Head and Inquest gets the long-term loan, and I would also be willing to invest money in Head and Inquest.